Yeah, if you look at what drove the market since the March 23rd bottom, it was the stay-at-home trade. So it was large cap tech, which is 20% of the S&P, healthcare, and big box retailers. All these companies actually benefited from their business models during the shutdown part of the economy for the last 3 months. So it was not entirely irrational that these stocks were going up. It just so happens that they're so heavily weighted in the S&P that it took the index with them. And something to point out is that the S&P is not a good reflection of the U.S. economy, but really is levered to tech and levered to healthcare. So it is healthy that the cyclicals and healthcare actually traded somewhat together today, because you don't want that kind of disconnect. We had at one point a 32% outperformance for the 5 large cap tech stocks versus the rest of the S&P year to date. We've never had such a disconnect before, suggesting that the two were going to meet somewhere. So the sell-off is healthy. I think we will come in closer, more here, maybe 10% altogether. I think the catalyst going forward would be some fiscal that we should get sometime in July.
Alicia, Rosanna joining the conversation here. And why did the markets need the Fed to tell them what they already knew? What does that say about the psychology of the current markets and the participants?
Rosanna, that is a great question. The truth of the matter is most economists have predicted at least a 10% unemployment rate by the end of the year, and the U.S. shrinking by about 6% year over year in 2020. That's actually not a surprise. It's a conversation we have with clients all the time. I think it was the sense of the labor market taking much longer to heal, because in the end, the U.S. economy is 70% consumption, and if your labor market is fractured and disconnected from the jobs for too long, you really can't get growing again. And I think that was really the message that the market heard yesterday. But the other message the market should have heard, which is the Fed is saying that they really are not worried about elevated asset prices, meaning they're not going to stop the rally in asset prices, because the Fed needs easy financial conditions to get the economy going. And that's actually a message that we got yesterday also, that the market basically ignored.